Welcome to the Deep Dive. Today we're unpacking something, well, pretty unique actually. It's this idea of a multi-venue hub, built just for creators. Think studios, community spaces, even entertainment, like these experiential lounges they mention, all in one spot. Our deep dive today is specifically focused on the Hive Creators Guild HTX. It's billed as Houston's first multi-venue creator hub.
That's right. And their mission, it seems, is really about, unlocking Houston's creative potential. The stories, the brands, the energy. They plan to do this with a whole range of offerings, creating a kind of ecosystem for creators.
Yeah, and we've got some really interesting documents here. They lay out the whole vision, the market strategy, financials. There's even this ninth revenue stream that sounds intriguing.
Yeah.
So let's get into it. What is the Hive, really? And why Houston? Why now? Okay, so the basic idea, the core concept, is it's a place where creators can do pretty much everything. You can produce your content, maybe perform it, and then even, like, hang out or experience some kind of entertainment. All there.
Exactly. It's meant to be seamless. You could finish recording a podcast, then maybe catch a comedy show downstairs, or participate in one of their immersive art things.
Interesting. That holistic idea sounds good, but is there really a market for it?
Well, that's where it gets compelling. Texas has this huge creative economy, like $11 billion, huge. And Houston specifically, it's actually the fastest growing market for content creation in the entire South right now. So the demand is definitely surging.
Okay, $11 billion, fastest growing.
Yeah, and then there are the film incentives. Post SB 22, Texas put up this $300 million biennial rebate pool. You can get up to 25% back on qualified spending in Texas. And the Hive is positioning its studios to qualify, especially for things like post-production or podcast spinoffs.
Okay, so that's a big financial boost. A strategic tailwind, as they put it.
Definitely. It makes producing content there much more attractive financially.
Right, so you've got this big creative pie, Houston slice is getting bigger fast, and there's this financial incentive. But what's the actual gap? I mean, surely there are studios in Houston.
There are, but surprisingly few professional podcast studios. Our sources say less than 5 citywide. And crucially, none of them combine that studio offering with, say, a professional bar, a training academy, and these immersive events they're planning.
Okay, so it's the combination that's unique.
Exactly. That blend is their key differentiator. They're filling a niche for a complete creative ecosystem, not just renting out rooms. And this seems to be resonating already. Let's talk about their early traction, even before they've fully launched. In just the first 6 months of, pre-launch marketing, they've pulled in over $100,000 in revenue.
Wow. Okay, $100K before the doors are even fully open.
Yep. And that includes getting over 50 paying podcast clients signed up.
50 clients already.
Plus 12 corporate events booked, and they've run 8 of these Hive experiences, which apparently sold out completely.
Okay, sold out experiences too. That is really interesting. It suggests the demand isn't just theoretical.
Right. It validates that people want these different services they're offering, and the sales cycle seems pretty short. They're not waiting months to get clients.
That makes sense. So this early success points to real demand. How does this translate into their actual plan for making money? This 8-stream revenue engine they talk about. Let's maybe walk through those streams. Okay, first up, the podcast studio, but for consumers, B2C. They're charging $175 an hour.
That's the rate. And they project, based on 270 hours a month, about $567,000 a year from that. These are meant to be high-quality, pro-level studios for anyone.
Gotcha. Then number 2 is enterprise podcasts, B2B. So making shows for companies.
Exactly. Turnkey solutions for businesses, universities, you name it. Strategy, production, editing, distribution, marketing, the whole package. They figure they can handle 4 clients at once, with retainers between $3K and $12K a month. Even just one client brings in $36K annually in their base model.
Okay, a full service there. Third,
the photography suite. That's $65 an hour, projecting around $70K a year based on 90 hours a month. Fully equipped, less chances to upsell gear rentals or their own photographers.
Makes sense. Number 4 is the bar and lounge. How much are they expecting from that?
About $216K a year. They're figuring an average check of maybe $20, $32 and about 900 customers or covers a month. But it's more than just drinks revenue. They see it as the social hub, the place people connect, network, which then hopefully drives business to the other streams.
Right, the social lubricant, I think they called it. Okay, number 5.
The Content Academy, offering courses on podcasting, video, storytelling, acting, marketing, monetization, all that stuff. It's $97 per seat, projecting about $36K annually. And the idea is this also feeds potential clients into their studios and other services, upskilling the community.
Clever pipeline. Okay, sixth stream.
Event space rentals.
Hmm.
Basic corporate events, workshops, private parties. They figure $2K for a 4-hour block, 5 events a month. That's $120K annually. Fully equipped space.
Number 7. This one sounds fun. Weekly comedy series.
Yeah, $25 a ticket, 240 seats a month, bringing in about $72K. The goal here is building a regular crowd, driving traffic consistently, and, selling drinks at the bar.
Naturally. Okay, and the 8th one. The Hive experience. What exactly is that? Escape room meets paint and sip.
Kind of. It's described as a daily immersive experience for about 40 guests at a time. $50 a ticket, aiming for 300 guests a month. That adds up to $180K annually. And they really emphasize making this super Instagrammable, hoping for lots of word-of-mouth marketing.
So 8 distinct ways they bring in money. That's quite diverse.
It is. But then there's this other layer, this strategic IP position. They're framing it almost as a 9th revenue stream.
Okay, IP. Intellectual property. So not just helping others make content, but making and owning their own stuff.
Precisely. Or partnering strategically, so they co-own content created there. It's a shift from just being a service provider or landlord.
That does sound like a bigger long-term play. How does owning the content change the game for them?
Well, it fundamentally changes the valuation potential, doesn't it? Instead of just collecting rent or hourly fees, they're building an asset library. Think about it. They could monetize that IP through ads on platforms, subscriptions, licensing it out to others, syndication deals, or attracting bigger brand sponsorships directly tied to their content.
Right. It makes the business potentially much more scalable beyond the physical limits of the space.
Exactly. It's transforming from purely services to potentially a media enterprise. So how does this all stack up financially? Looking at their year 1 projections, even at what they call a base case, just 25% utilization across everything, they're projecting revenue in the millions. The graphs suggest around $6 million.
$6 million at only quarter capacity. That sounds ambitious.
It does, but they back it up with strong economics. They're projecting a 79% contribution margin. That means a big chunk of every dollar earned goes toward profit after covering variable costs.
Okay, high margins are good. What about just breaking even?
That's another strong point. Their break-even is apparently quite low, just $51,000 in revenue per month. That's less than half of what their base case projection brings in.
It's a lot of cushion there. It makes them less vulnerable to, say, a slow month.
Right. Uncommon financial resilience, as they put it. And they also note that for every extra 10% of utilization they achieve, it adds about $160K to their annual EBITDA.
EBITDA. Earnings before interest, taxes, depreciation, amortization.
Yeah.
So significant upside potential, too.
Definitely.
All right, the numbers seem thought through. So what do they need to actually, get this fully launched? What's the funding request?
Okay, the main ask, what they call option A, is for $1 million. This is for working capital and the fit out, basically equipping the space. They're proposing a loan structure, 10-year amortization, 9% fixed APR. That works out to about $12,700 a month in principal and interest payments.
Okay, and what are they offering as security for that million?
Good question. They're putting up $500 in equipment they already own, plus $150K in existing real estate, and importantly, personal guarantees from 4 principals.
Personal guarantee. So the founders are putting their own skin in the game.
Yes. And based on their projections, this package gives lenders a debt service coverage ratio, DSCR, of 3.1x.
3.1x, meaning their projected income is over 3 times what's needed to cover the loan payments.
In the base case, yes, which is generally considered quite strong. They do also mention an option B, which is much larger, a $4 million package, but that includes acquiring the actual property. That's more for lenders who prefer real estate collateral.
Gotcha. So you mentioned those Texas film incentives, SB 22, earlier. How directly do those help with, say, covering that loan payment or just making this whole thing less risky for a lender?
That's actually a key point they make. The SB 22 incentives provide a direct financial benefit in a couple of ways. First, that 15-25% rebate on qualified spending literally reduces their operational costs. Lower costs mean higher profit margins.
Okay, direct cost reduction.
Second, those rebate payments provide extra cash flow. That cash flow directly improves their ability to make those loan payments, boosting that DSCR figure even further.
So it makes the debt coverage even stronger than projected.
Potentially, yes. And third, it just acts as a significant financial buffer overall. If other revenue streams fluctuate, having that reliable rebate income makes the whole venture feel more stable and frankly less risky to a lender.
Right. It de-risks the investment somewhat. Okay, so beyond the financials and the market opportunity, what really makes the Hive stand out? What's their competitive edge?
Well, they highlight a few things. First is that unique mix of venues we talked about. Premium studios, bar, academy, immersive events all together. They claim it's a first for Houston.
That combination again.
Right. Second, the physical space itself is designed to be modular. Flexible floor plans mean they can adapt easily, maybe rent it out as a film set one day, host a big corporate event the next. Versatility.
Makes sense. And third,
Built-in traffic. The weekly comedy shows, the daily Hive experiences. These aren't just revenue streams, they're designed to constantly bring people into the building. And once people are there, the hope is they'll use the other services, hang out at the bar, create that cross-selling synergy.
a self-feeding ecosystem, ideally. Okay, and who's driving this? Who's on the team?
The founder is Baran Rollins, who apparently has about 10 years of experience across finance and creative fields. They also mentioned having a studio head with over a decade working in Hollywood and a dedicated marketing director.
So some relevant experience there.
Yes. And they're also supported by advisors listed as studio executives and consultants, suggesting they have access to broader industry knowledge and connections.
Okay, so let's recap.
Yeah.
We've got this concept, the Hive. Seems like there's proven demand, even pre-launch, which is impressive. They have a very diversified revenue model, 8 streams, plus that interesting Ninth IP stream.
Mm-hmm.
The economics look strong on paper, high margins, low break-even. And they seem to be tapping into a real growth area in Houston's creative scene, with those film incentives adding another layer.
Yeah, what I find really fascinating is how they're weaving together several big trends. You've got the creator economy boom, the demand for experiential entertainment, and leveraging local incentives like SB 22. It's not just one thing, it's how they combine them into a single business model that seems quite innovative.
So, thinking about this for you, the listener, what does this all mean? Maybe the Hive is a really good example of how businesses are changing, moving beyond just selling a single product or service and instead creating these, well, ecosystems. Places focused on community, unique experiences, and finding synergies between different offerings.
Yeah.
It's not just about content, right? It's a whole package.
Exactly. It's about building a destination, a community hub, where all these different elements feed off each other.
So here's something to think about. Imagine a place where you could record your podcast, maybe see a live show, learn something new at the academy, and then do this immersive art thing, all in one building. What other kinds of businesses, what other industries could maybe benefit from that kind of multifaceted, community-driven approach? Something to chew on.